Okay, let's start. So, I guess most of you I have met during the introductory week. My name is Rasha. You can call me just like that. You don't have to use the titles and stuff. Here are my contact details. You can contact me. You have my phone number, my email, my office address. Nevertheless, I strongly prefer contact by email. There are 350 students in this class, and even though my office phone number is forwarded to my cell phone, I prefer contact by email because, I will answer your phone calls, but, if it's not really urgent and you cannot wait for me to answer the email, then contact me like that. Otherwise, just use the email. There are a lot of students in this class. There are like 330 students in this class, so we have to introduce some rule to make this actually work. As you can see, there are very few people sitting in this classroom, and yesterday I was teaching like hundreds of students in one classroom, so people were optimizing heavily. I guess they don't like to come here on Fridays. I don't like that either, but I come. So rules are no optimizing. And actually, every year I conduct surveys of students. I will do this with you as well. I will send you an online survey that I will ask you to complete and ask to help me improve my class. And basically I ask you many things about the class, and one of the question is, what is the worst feature of my class? And when I was teaching here for the first year, by far the most frequent answer was the optimizers. So optimizers harm other people, so please do not optimize. From next week on, I will ask every time student representatives to check whether there are optimizers, and if there are optimizers in the class, I will ask them to leave the class. Basically, optimizers will be kicked out from the class. What else is important? When you contact me by email, there are rules of communication that I want you to use because there are lots of students in this class. What are the rules? The rule is when you ask a question, you are free to ask any kind of question. I answer all the questions and I'm very efficient in that. I answer your emails basically with very, very small delay. I answer them very fast. So don't be afraid to ask questions. Just feel free to ask whenever something is not clear. But when you ask the question, you are also, if you want me to reply to this question, you are asked to provide the answer to this question. The primary reason for that is that our background is completely different. I've been studying for a long period of time in my life. I studied astrophysics before doing my PhD in economics, and I have no idea what is problematic for you to figure out. So providing an answer, providing even a wrong answer is helpful for me to understand what you find difficult, what you do not understand, what is wrong in the way you think, etc., to be able basically to provide you with a proper answer. But this also kind of increases the cost of asking questions. You cannot just send me a question and ask me why. I don't answer these kind of questions because 95% of questions are asked by very small number of people, are asked by less than 5% of people. This is what tells me statistic from the last year. And I have answered last year more than 600 emails. And I have no problem with that. I will gladly do that. I will gladly answer your emails, but you have to invest some effort to show me that you are actually interested and not that you are, asking question for the sake of asking question. Many of the questions that you ask, you can just check in Wikipedia, in Investopedia, Google for it, and it will be clear for you after like 20 minutes. And I need to invest like 10 minutes to answer your question properly. So first try to invest some time to figure out whether you can figure it out on yourself. If you cannot, I will be happy to answer this question. There is no problem with that. But you just need to invest some effort and not just to ask question for the sake of asking. So we use only one book. The book is Brealey-Myers' book. Now it's called actually Brealey-Myers-Allen book. I don't care which edition of the book you use. Some of you have asked me what is the ISBN number of the book. I have realized that on Amazon there are basically two books, same edition, two different ISBNs, different price. One is much more expensive than the other. I don't care which one you use. For me, it's exactly the same. Use whichever book you want. I don't care which book you use, which ISBN number you use. Actually, I don't care about the edition as well. I mean, older editions are okay too. There are small mistakes in older editions. There is one important mistake in older edition in the chapter that we cover, but you know, I will tell you where this mistake is. I know exactly where this mistake is. I will tell you where this mistake is, and this mistake should not be a problem. I will also provide you with the lecture notes, and these lecture notes, I recommend you to read them before you read these chapters in the book, because they tell you what is important and they kind of allow you to concentrate on important things when you read the book. But read the book regularly. I mean, this is a pretty intensive course. We have only like 5 weeks. This is a 5-week course that covers first 10 chapters of the book. This is very intensive course. If you do not work on a regular basis, I mean, it will be tough for you. It's difficult to catch up. We cover lots of different topics. I will give you homeworks on a weekly basis. Every week you will have one homework, approximately. And you will be required to send me this homework by email. You will get detailed instructions how to do this. The point is, homework is not obligatory. It will not be graded, but my experience tells me that people that submit homework pass exam much easier, and they score much higher grades on the exam. So it's highly advisable that you actually do this homework. And homework has a learning function. It's not there to test you. It's there that so you could learn something. I select exercises from this book on purpose. I will select specific exercises that will allow you to learn something important that might be important for you. So do the homeworks. In the introductory class, I have told you a bit about myself, so let me repeat if somebody was not here before. I'm quite new here at EPS, though this is not really true. In a sense, this is my 3rd year I'm teaching here, and as I can see, I'm quite a veteran at EPS because people change quite frequently at EPS. They just come and go, come and go, come and go. So I don't know, if this was some other school, I would probably be still just a freshman here in a sense. But at EPS, I'm kind of a veteran with the 3rd year. I mean, I'm here 2 whole years, which is a lot in EPS standards. So before coming here, I spent lots of time in Barcelona, New York at NYU, and at Berkeley, and now, at least for some time, I'm here. I will start this lecture in the same way I have started the lecture in the introductory week with by showing you this photo. So this is a photo taken in 1895 somewhere in the US, and these are elementary school kids. Elementary school in the US was for the age of 6 until the age of 14 or something like that. It was 8th grade school. And when they were supposed to graduate from this elementary school, they were basically asked, among other exams, to pass the state exam in arithmetics. And this was the exam in arithmetics that they were supposed to solve. They had also geography, history, they have different subjects, but one of them was arithmetics. In this arithmetic exam, there are actually 3 questions that are highly related to this course. These 3 questions are basically questions that deal with interest rate calculus. One of them actually implicitly assumes that you know the concept of present and the future value of money. These are the most important concepts that you will learn in this school, if you ask me. And now, if you look at this picture, there is one big difference between these 2 groups of people. This is how elementary school students look like in 1895, and this is how basically students at EPS look like in 2011. And the big difference is not in the fact that kids on top were very frequently hungry. The big difference is actually that these kids on top were actually able to solve these kind of problems. And these kids on bottom didn't know how to solve these problems when they were 14 years old. And this is not their fault. It's the fault of the educational system, which, I don't know, somehow managed to evolve from 1895 to 2011 to end you up to create you clueless about basic financial concepts, which I think is a big big mistake. But I mean, the point of this class is not to learn you how to solve these problems. The point of this class is to modernize this setup and to apply this concept to something that is much more appropriate for the time that we live in. So basically, the point of this class is to learn concepts that will allow you to deal well in your normal life with mortgages, with loans, when you go to a bank, to understand what is bank charging you, what is the interest that you are supposed to pay, to understand what are bonds and how to price bonds, to understand what are stocks and what determines the price of a stock, what is the relationship between risk and return and how you create optimal portfolios and stuff like that. This is the point of this class. But there is another point. We will learn a bit about how do you value firms that are not traded at stock exchanges. So if a company is traded at the stock exchange, what's the value of a company? Well, you can check the price of one share. You know how many shares this company has. You can multiply these two numbers and you get the total value of a company. But there are many companies. There are many more companies that are not traded at stock exchanges compared to those that are traded at stock exchanges. One good example is Twitter. Twitter is, you cannot go to New York Stock Exchange and buy 30% of Twitter. You simply cannot do that. Twitter is not exchange-traded company. It's a privately owned company. How do you value these kind of companies? You don't know what's the stock price of Twitter. There is no such thing as a stock price of Twitter. But nevertheless, if you Google for the value of the Twitter, you will find the value of the Twitter. People are somehow able to estimate the value of the Twitter. And what's puzzling about this estimation is if you observed, for example, in March of 2010, the value of the Twitter, it was estimated to be around $1.5 billion. And you know, in March 2010, Twitter was a company that was losing money. And it was actually quite good in losing money for previous 3 years. So for 3 years since it was founded, it was just losing money. And it was losing lots of money. It was a very expensive company to maintain, and nevertheless some people thought it was worth 1.5 billion. How can something that is losing money be worth anything in a sense? This is the question that we want to answer in this class as well. So now I will start with the formal part of this class. This was an introduction. And if you ask me, this is by far the most important class that you will have in this semester for sure, and if you ask me, until you graduate. Because it teaches you some basics that are super important for everything that you will do in this school. If you want to do marketing, if you want to, for example, design a marketing campaign for some product, I mean, it's important to know actually, is it worth doing? And in order to know whether it's worth doing, you have to understand some concepts that we will learn in this class. If you want to do taxes, for many purposes, you have to tax a fair value of what you have, not a book value. But you have to be able to calculate what is the fair value of some financial product. In order to be able to do that, well, you have to attend this class. So if you ask me, this is some basic thing that people in 1895, some of these things were learned in elementary school. And I believe that, you know, this is by far the most important class that you will have in this semester at least. So we start with the chapter 1 of the book. And actually, you should, I know that it's a short period of time, that you have basically only a weekend. But by the next week, you should read first 2 chapters. We will cover now first 2 chapters of the book. And you should read them by then. If you don't have the book yet, I know that some people will have excuse not to read because they still didn't get an opportunity to buy the book. It takes some time for the book to come from Amazon, etc. I will upload scanned pages of first 2 chapters so you don't have an excuse not to read them. I will scan them and upload them to the CampusNet so you can read them. So there is no excuse not to read first 2 chapters. Okay. These are the topics that are covered in the first chapter of the book. It tells us what's a corporation, the role of financial manager, basically who is the financial manager, and talks a little bit about the separation of ownership and management. Now I will try to tell you why is this so important. I will actually spend at least 10 minutes talking about the corporations, and I will do that because I believe that the corporation is something that has changed the world as we know it. It has completely changed the world as we know it today. So if you want to start a business, any business, you need to form some kind of a company. And you can basically do it in three distinct ways, at least in let's say in Western world. I don't know, maybe it's different in some other parts of the world. And three different legal structures that allow you to do that are sole proprietorship, partnership, and corporations. Sole proprietorship is when you are the owner of the company and the main manager of the company. And partnership is something similar, but there are a couple of few people that have met together and made a partnership and created a firm. But there is a big difference between sole proprietorship, partnership, and corporations. Corporations are things like Microsoft, IBM, Ford, I don't know, General Motors, whatever. And the big difference is the concept of liability. What is a liability? So sole proprietorships and partnerships have what is called unlimited liability. That means, for example, you create a sole proprietorship and you take a loan from a bank for your firm, and you cannot and your business goes down, and your firm cannot repay this debt. You, as a sole proprietor of the firm, you are responsible for this debt with your personal wealth. You have to sell your house to repay this debt. Unlike if you own shares of Microsoft, if Microsoft goes bankrupt and it cannot repay its debt, you do not have to sell your house. You are not liable. There is no liability. There is a limited liability. You are not required to cover the debts of the company with your personal wealth. You are the shareholder. You are not liable for the company. And this is a big difference. And actually, this concept, introduction of this concept of limited liability has completely changed the world as we know it. This concept was introduced in 1602 when the first corporation was founded. It was called Dutch East India Company. And actually, this is the oldest physical example of a share, of a stock. This is a piece of paper and from 1606. So the first one was issued in 1602, but this one is from 1606. The one from 1602 didn't survive. And the guy who owned this piece of paper basically owned a piece of Dutch East India Company. And Dutch East India Company was a company that was basically trading spices. It had ships that went from Holland to India, bought, I don't know, pepper, tea, whatever, and brought these spices to Europe. And it was a very successful company for quite a long period of time. And why do I say that this changed the world as we know it? Well, this was a very risky business. Trading of spices. It was very profitable, but very risky. Because, you need ships to go to India. And these ships were very expensive. And, trip to India and back was a lengthy trip. And you need a crew to basically drive these ships. And you send a ship there is a big storm, your ship sinks, you're out of crew, out of spices, out of ship, you lose lots of money. And imagine that you had kind of your sole proprietorship. Then when this ship sinks, you have to sell everything you have. You have to sell your house. You have to sell your kidneys. You have to sell your family to slavery. I mean, there is no way out of this thing. And what changed the landscape of economics in the world and that period was introduction of limited liability and creation of corporation. Because people were not liable with their personal wealth anymore. They could invest in Dutch East India Company, but not to be afraid that they will have to sell their wives and kids to be slaves. And this has created tremendous economic growth because people started investing their savings into economy. This has created tremendous economic growth that basically continued until I don't know, last decade. And some people will tell you, even some Nobel Prize winners and some famous economists will tell you, we are living in the era when capitalism is dying. Capitalism killed itself. I mean, if you ask me, this is some crazy communist talk. I mean, just look at this chart. I mean, this is what you can do on Google. This is Standard & Poor's 500. This is basically index which tells you how the US economy was growing. You cannot plot it for more than from 1950. But believe me, before 1950, it was even much better. Growth was much steeper. I mean, if you plot it from the beginning of the 17th century, the growth was much steeper than here. And they tell you that this thing, on the end, represents the death of capitalism. But let's disregard everything that happened in the last 400 years. Let's forget about that, and this is the death of capitalism. Yes, sure. I mean, we had big financial crises in history many times, but you know, economy has survived. There was this famous tulip crisis when people in Holland became crazy about investing money in seeds of tulips. They were investing so much that price of tulips has jumped. Like, I mean, for a bag of tulips you had to sell your house, basically. It was so expensive. But then at some point somebody realized, come on, this is crazy. And then prices, economy collapsed. But you know, capitalism has survived. You know, this is, I'm talking about 17th century. In 17th century, we already had stocks. We had companies like Dutch East India Company that was trading in London and Amsterdam Stock Exchange simultaneously. You had dually traded stocks in 17th century. And now, after 10 years of, you know, slump, they tell me capitalism is dead. Yeah, sure. Okay, so what's the difference between sole proprietorship, partnership, and corporation? Basically, there are different dimensions to it. Who owns the business? Well, in the case of sole proprietorship and partnership, it's very clear. Partners are both managers and owners. While in the corporation, shareholders do not manage the corporation. Usually, this is not the case. I mean, you had, I don't know, if you look 10 years ago, Bill Gates was the major shareholder and he was the CEO of the company. But now he's not anymore. And you know, in the case of corporation, if CEO dies, nothing happens. You know, Steve Jobs died. Apple is still there. But if you are the only owner of the company, if you're a sole proprietor of the company, if you die, company is gone. Company doesn't exist anymore. With the corporations, this is not the case. Now the question is, are the managers and the owners separate? In case of corporations, this is usually the case, while in partnership and sole proprietorship, this is not the case. And we'll see why this is important, very important later, because incentives are different for managers and shareholders. And probably the most important, if you ask me, component is what is the owner's liability, whether it's unlimited or limited. And this concept of limited liability has created tremendous growth. I mean, there are some forms of partnerships with limited liability. They are called limited liability partnerships, or LLP. But these are forms of companies that are usually created in some tax safe havens like Bermuda, Panama, and some weird places where people try to avoid taxes. But in Western world, limited liability partnership is not something that is so common. I mean, it's starting now and it probably will grow to something more common, but currently this is not the mainstream. And now there is the question of taxes. Basically, corporations are taxed in a sense 2 times. Corporation itself is taxed, and then later you are taxed again when you get dividends on your personal income. But I'm not a tax expert, and you have classes in taxes, and they will tell you many more details on this. I mean, for this class, this is just a minor issue. I don't think that it's that important for this class. Now let me tell you a little bit about what are financial markets. Well, financial markets are the main source of funding for corporations. Like Dutch East India Company, when they wanted to build chips, they went to a stock exchange and said, okay, we want to sell you share in our company, give us some money, and we will use that money to build chips and send them to India. This is how it works for companies. They can use different financial products to raise money. They can issue stocks, bonds, whatever. We will talk more in details about stocks and bonds later. But basically, this is the main source of funding for the corporation. Also, there are sources for investors' liquidity. What does it mean? Well, liquidity is a concept. Imagine you are running Dutch East India Company and you have a ship that should come from India in 2 days from now. But you have to pay the salary for the crew of another ship that is sailing to India today. But you don't have the money. So you go to a bank, you borrow money, you pay them salary. When your ship arrives tomorrow, you pay the back debt to the bank. So liquidity is this kind of shortage of money for a short period of time that you know that you will be able to overcome. And to manage this liquidity, you can use financial markets. And one of the players in the financial markets are banks, where you can go and borrow money and to manage these kind of short problems with liquidity. There are also sources for risk management. Imagine that you are a baker and you are running a bakery, and big supermarket chain like Reve approaches you and tells you, okay, we want to sell your bread in our store. You are an awesome baker, but we want to sell we want to have your product in our store. Let's make a contract that for next year, every day you will deliver us, 1,000 kilos of bread. And let's agree that the price will be $1 per piece. And you say, wow, this is great. But the problem is what happens, when you're producing bread, you have some inputs. You need flour, you need water, you need, for example, oil to heat up the oven. And all these inputs are basically determining what profit are you going to make if the price at which you are selling is fixed. So can you somehow manage this risk? You are a baker, you make money, you make bread, you sell the bread, you make money. You are not a guy that can predict what is going to be the price of fuel for next 1 year. You are not expert in oil prices. And you want to get rid of this risk. And actually there are financial products that allow you to do that. You can get what is called a forward or futures contract on oil, which can guarantee you the price of oil for next 1 year. So you can be safe, you can immediately know how much you will earn in this contract with Reve. Also, financial markets are sources of information. In which sense? Well, imagine you want to know what is the total value of Microsoft Corporation. How can you know that? How can you determine how many dollars is Microsoft Corporation worth? Well, you can go, on Google Finance, Yahoo Finance, check what is the current share price of Microsoft, and there are millions of Microsoft shares. You just multiply these two numbers and you know what is the value of Microsoft Corporation. Markets are even much more sophisticated source of information. For example, by observing some types of interest rates, you can say what market participants think about the future state of economy, whether it will grow or whether it will go down. We will talk more about that when we talk about interest rates and bonds. But you can get this kind of information. You can get information about the future events in the markets, actually what other people think that will happen in the future, but just observing today's prices, rates, etc. Now, next thing that book wants to tell you in this chapter is what is going to be your job when you grow up. Majority of you end up either in some company or in some investment bank or whatever, and you become a financial manager. Well, I think that this is wrong. You will not be, after you graduate, you will not become a financial manager. You might become financial manager after 10 years, after 15 years. So this is basically a story of what is your future boss's job. And not what's your future job. Maybe it's your future job in 20 years, but, your first job certainly will not be CFO of Microsoft. You don't become CFO of Microsoft after you graduate. You have to first work for a CFO of Microsoft, and then maybe sometimes in 20 years, if you survive, you will become one. So this is what your boss does. First, he needs to raise money from the financial markets. He needs to go to, I don't know, stock exchanges, issue bonds, issue stocks, go to a bank, borrow money. He has to get money somehow and invest this money into firms' operations. And you know, firms do many different things. Microsoft is, I don't know, creating Microsoft Windows. He has another product, Microsoft Office. They create operating system for cell phones. They produce keyboards, mouses, and you know, he has limited amount of money that he can invest. He doesn't have unlimited amount of money that he can do whatever he wants. No, he has to choose the most profitable things to invest, the things that will increase the shareholders' value the most. So he has to choose among the projects. He has to be able to evaluate this project is better than this project, and I want to invest exactly in this project. Then this project gives him back some money, and then he needs to decide whether to put it back to financial markets or to reinvest again. Now, you know, your boss, when he tells you, he will ask you things like, okay, which securities should I buy? You should learn this terminology. And you know, in this class, I will not talk too much about the terminology, even though it's important. But I will not ask you to learn definitions. I will not ask you, okay, what is the definition of investment? Or what is the difference between capital and financial markets? I will never ask you these kind of questions. Basically, in my exam, you will have problems to solve. You will have to calculate stuff. I will ask you, should I buy this or should I buy that? Or what's the value of this or what's the value of that? I will never ask you what's the definition of this or what's the definition of that. Your boss will never ask you these kind of questions. Because your boss doesn't care whether you know the definition from the Brealey-Myers book or from some other books, and they might be different or whatever. He wants you to be able to do stuff. He asks you, do me this, do me that. This is how real life works. Nobody asks you for definitions or whatever. So this is not a class of memorizing things. And actually, in the exam, you will be allowed to bring a piece of paper with you, A4 piece of paper, and you will be able to write whatever you want on this piece of paper on both sides. I don't care what you write. I don't care whether you memorize formulas or you keep them on your paper. I don't care whether you know how to derive formulas or you keep them on your paper. I want you to know to be able to do stuff like your boss will ask you to do. And this is how real life works. You know, your boss wants you to do something. He doesn't want you to know formula for calculating this by heart or know how to derive formula. He will ask you, should I buy this? He will ask you, should I invest into this project? What's the value of this? What's the return on this investment? This is how real life works. So I will not tell you the definition of these words, but you have to read the book to be able to understand the problems. When somebody asks you, should I invest in this security? I mean, what is security? So read the book. This is not what I will tell you. I mean, my book tells you these things much better than I can ever tell you these things. So this chief financial officer, he's basically responsible to chief executive officer, head of a company. In Germany, they call them often president of a company. And below him, he has treasurer and controller. And this treasurer guy is responsible for cash management, raising capital, and banking relationship, while the controller is, responsible for the preparation of financial statements, accounting, and taxes, and this boring stuff. So, let me tell you just a little bit in this chapter about the ownership versus management and what's the problem. The problem is that, yes, corporation introduced a really great stuff, which is limited liability. But the corporation introduced one problem. And the problem is that owner and the manager are not the same anymore. So in the sole proprietorship, owner and the manager are the same thing. So if the owner's goal is to do something, well, that's the same goal of the manager because they are the same person. In the corporation, this is not the case. You have the problem that shareholders which own the company maybe want to do one thing and the manager maybe wants to do another thing. For example, shareholders want to receive dividends. They want money in their pockets. Well, the manager, you know, he wants high salary. He wants money for himself. He's not receiving dividends. He doesn't own the company. And this is a big problem for the corporations. How to strike a right balance between these two things. And you will actually have a special class that will deal with this. I think that you learn about this in economics classes, about these agency problems. And we will talk a little bit more about that, but this is not the main topic of this class. So we move to chapter 2. And basically the most important thing in chapter 2 that we will learn is what is the present value, what are the foundations of net present value, and what are the goals of every corporation. So to start with that, I will actually cover some part of the chapter 3, where they talk about interest, because knowing how to calculate interest is by far the most, this is the basis for the concept of net present value. And some of these things we have covered actually in our introductory week. So imagine that you have $100 and you want to invest this $100 to a bank or to some other project that earns 8% per year. How much will you have after 1 year? Come on, this is an easy question. You will have 108 after 1 year. This was easy. But what about when you invest $8, not $100? You invest some $8, where A can be anything, 500, 5,000, whatever. How much do you have after 1 year? It's also easy. It's A times 1.08. Now the question is, but what happens when you invest for more than 1 year? What happens when you invest for 2 years? Well, then it depends. Then it depends how you calculate interest. And there are different ways how you calculate interest in real life. And we will now see some of these differences. So here is one very simple and almost useless way, but you need to know it, which is called simple interest. And simple interest works in the following way. Banks don't do it like that. Nobody basically does it like that. You invest $8 to a bank for 8% for 1 year. After 1 year, you end up with 8 times $1.08. But in the next year, you do not reinvest everything. You reinvest just $8 again and keep this 8 times 0.08 in your pocket. You don't do anything with this money. And then after the second year, you earn additional 8% only on A, on your principal. A is a principal in this case, and 8 times 0.08 is interest that you earn. So after the second year, you will end up again with 8 times 1.008, but you also have this 8 times 0.08 from the previous period. So basically you end up with 8 times 1.016. So after 2 years with this simple interest, you have basically interest that you earn is 2 times R. After 3 years, it's 3 times R. After n years, it's n times R. This is how it works when you do the simple interest. In the simple interest, you do not earn interest on interest. You earn only interest on principal. And since this is linear in time, you can actually apply it for any time period. You can apply it for 2.5 years. You can apply it for 0.3 years. You just plug in, instead of this t, any number which is a proportion of a year. It doesn't have to be the whole number. But actually how it works in real life, people do compounding. So how does the compounding work? Well, you invest $8 in a bank for 1 year. After 1 year, you end up with 8% more, which is basically 8 times 1.08. Well, but you don't keep this in a pocket. Now you reinvest 8 times 1.08, and you don't reinvest only A. You reinvest both principal and the interest. And now your new principal is not 8 anymore in the second year. It's not A anymore. Now it's 8 times 1.08. So you earn 8% on top of all of that, not on top of A only. So basically after 2 years, how much do you have? Well, you have 8 times 1.08 to the square. This is how it works in real life. This is what you do in a bank. Actually, banks do something more complex, and we will see what banks do. So basically, after 1 year, when you compound things, after 1 year, you have to multiply by 1 plus r. After 2 years, you have to multiply by 1 plus r to the square. After 3 years, 1 plus r to the third, etc., etc. So, after n years, you end up by having a times 1 plus r to the power of n. And actually, most banks account and loans employ some form of compounding. Now the problem is that, when you put money on your bank account, every time you shop, you have less money. So amount of money on your account is changing all the time. So banks have to apply some more sophisticated technique to calculate how much interest do you earn on what you have on your account. As long as the amount is changing every day, well, they have to calculate how much interest do you earn every day, not annually. And usually they will quote you something, what is called nominal rate. They will tell you your nominal annual rate is, for example, 10%. But we compound, for example, daily. So what does it mean? That means that actually it's not that you earn 10% per year. It means that you earn 365th part of 10% per day, and then you compound every day. Now we will see how that works. So the nominal interest rate is basically the rate, and you have to apply the appropriate proportion of that interest rate over each compounding period. Let me give you an example. Let's say that the nominal rate is R, and that the bank is doing compounding quarterly. So what does it mean? It means that after 1 quarter, you will receive 1 plus R divided by 4 more. You follow me? So after 2 quarters, how much you will receive after half a year? Anybody?
1 plus R divided by 4 to the power of 2.
Exactly. And after 1 year, you will actually receive 1 plus R divided by 4 to the power of 4. So you will not receive R percent more. You will not receive nominal interest rate more. You will receive this thing, 1 plus R divided by 4 to the power of 4, if compounding is done quarterly. Now, compounding can be done at any frequency, and actually banks usually do it on a daily basis because amount on your account changes daily. So they have to do it daily. They are forced to do it daily. And you should read your contract actually how your bank does it. I mean, it has to be in the contract. And you have no idea how your bank does it. So basically you have no idea how much annually do you get. But usually in Europe, banks are forced somewhere to have written what is called effective interest rate. And what is the effective interest rate? Well, if you look the equation at the bottom left corner of this slide, effective interest rate is actually, for example, if this is done quarterly, this is the annual interest rate that you will earn after 4 quarters. So this is this number R prime. So in this equation, what would be letter M if compounding is done monthly? What would be M?
12.
Exactly. And if compounding is done on a half-year basis, if it's done every 6 months, what would be M? Exactly. Okay. But now, let's do one example to figure out how this works properly. Imagine I'm really desperate for money. I need $1 today. And you tell me, okay, I will give you $1, but in 1 year, you have to pay me 100% more. And I say, okay, I really need this money today. So after 1 year, basically, I have to repay you back $2. But let's imagine that you told me this nominal interest rate of 100%. And I ask you, okay, I need money for 6 months. Can you give me money for 6 months? You say, sure, my nominal interest rate is 100. That means that for 6 months I will charge you 50%. So after 6 months, I have to give you back $1.5. But after these 6 months, it turns out that I still need this money. So I ask you, okay, can we extend this loan for 6 months more? He said, sure, no problem. You owe me now $1.5 and I will charge you 50% on top of that. So after 1 year, effectively, I have to give you back $2.25. Now I ask you, what is the effective interest rate here? It is 125%. So if the nominal interest rate is 100%, if it's compounded semi-annually, effective interest rate in this case is 125%. Why? Because effectively after 1 year you have to pay back 125% more. So if bank quotes you only nominal interest rate and it doesn't tell you how frequently you do the compounding, you don't have enough information to actually know how much they are charging. Let's extend this to a monthly example. Let's say that I want to borrow money for 1 month again. So if I borrow for 1 month, basically if I divide 100 by 12, I will get 8.5. So basically monthly rate is approximately 8.5%. So after 1 month, I will have to pay $1.08. Then after 1 month more, after 1 month more, after 1 year, I will have to pay 1.085 to the power of 12, which is $2.66. Which means that if the same nominal rate is used and just a different compounding frequency, your effective rate is different. After 1 year, effectively you have to pay much more if the frequency is smaller. So basically, instead of if the compounding rate is once a year, I would have to pay $2. If the compounding frequency is once a month, I would have to pay $2.66. It's a big difference. So if bank gives you only nominal interest rate, and if they don't tell you how frequent they do the compounding, you actually have no clue how much you have to pay after 1 year. You cannot come up with this number, 2.66, if you don't know the frequency at which bank is doing compounding. But in Europe, they are obliged by law in most of the countries that they quote somewhere effective interest rates. And banks will quote these interest rates in a visible place when it suits them, and they will hide it when it's not suitable for them. So when does it suit them, and I mean, it's kind of trivial question, because you see, effective interest rate is basically always larger than the nominal interest rate. So when you ask money from a bank, they will often tend to tell you the nominal interest rate because it's lower. And you will actually in reality pay more. But when you invest money in a bank, they will tell you effective interest rate because it's larger than the nominal interest rate. So they will use this kind of tricks. I mean, they have to tell you effective always. But you know, in one case, effective interest rate will be somewhere in the footnote that you will never read. And in the other case, it will be on a big billboard. Okay, let's do this now on a daily basis, because this is what banks usually do. How do you do it? Well, divide 100 by 365, and this is how much you earn per day. You earn 0.274% per day. After 1 year, you end up with 2.714. Does this number remind you on something? Does this number 2.71 remind you on some very special number? It reminds you very much on number e, basis of a natural logarithm. And actually, what's amazing is that this number keeps popping out everywhere in the nature. If you measure your height, and if you measure your height until the belly button, this proportion will be equal to the square root of e, which is a golden ratio. It will pop out everywhere in the shape of leaves, in the way how seashell looks like. It pops out everywhere, and it actually pops out in the way how you calculate interest on your bank accounts. So let's do this hourly. How many hours are in a year? We can do this hourly, no problem. It's the same principle. So how do we do this? Well, we do it like this. Basically, this is for once a year, once a month, once a day. Basically, if you put n to go to infinity, you want to do it in infinite number of intervals a year, you get to the formula at the bottom, which is the definition of number e. This is how e is defined. This is how you calculate number e. I mean, the goal of this class is not to teach you how you define number e. You learn that in your high school math. The point is that you learn how to use this in order to calculate interest when interest is what is called continuously compound. This is what is called continuous compounding of interest. You have quarterly, monthly, daily, hourly, and you have continuous. Continuous when this period, when you split a year in infinite number of periods, not in 12 months, not in 365, in infinite number of periods. So let's generalize this. In the previous example, we were investing $1 at the interest rate of 100%. Now let's invest P dollars at the interest rate R. For example, P can be $50, R can be $10, 10%. So what happens if you in a sense compound every 6 months, if you compound semi-annually? Well, if you invest $50, you will end up with $55.125 after 1 year. Now basically we again want to take the limit of this thing over here. And let's do a little substitution. Let's substitute things. Let's define x as equal to n over r. This is some new variable. We will define x is equal to n over r. If x is equal to n over r, well then r over n is equal to 1 over x. And then the thing, we still have n on top. So n is equal to rx. But we also have the n in the limit. So n goes to infinity. If n goes to infinity, what happens to x? From the rightmost equality, you can see that if n goes to infinity, because r is some number, x also has to go to infinity. So it's easy to switch the limit in this case. So basically, this limit becomes equivalent to limit when x goes to infinity of this thing over here. And now we can rearrange things a little bit, and now the only thing that depends on the limit is the thing inside the small parenthesis. And we can take the limit of that thing, and this is the definition of number e. So basically, this is equal to p times e to the power of r. This is how much money you get after 1 year if you continuously compound. After 1 year, you get p times e to the power of r. And after 2 years, you get p to the power of 2r. And e is this number. This is just some number. You plug it inside. I mean, this is a number that your calculator knows. It's 2.71 something. So basically, after t years, where t actually can be whatever. It can be 2.5 years. It can be 3.6 years. It can be 0.3 years. You get this amount of money. P times e to the power of tr. And this is very convenient because, you know, in quarterly compounding, it's difficult to calculate how much you get after 1 month. Because in quarterly compounding, you don't know. I mean, it's not defined what you get after 1 month. With continuous compounding, we can calculate how much you get after any amount of time because the smallest subdivision is infinitely small. So let me give you an example. Imagine you have $50 and you invest this $50 at the rate of 6% for 10 years. And let's say that this is continuously compounded. How much do you get after 10 years? After 10 years, this is easy. You get 50 times e to the power of the r times t, where t is expressed in years and r is expressed as decimal number. So after 10 years, you end up with $91.1. There is another reason why we use this E thing, why we use this continuous compounding. We use continuous compounding because we have developed a really rich mathematical tool set to deal with the functions that have e to the power of something. And we are lucky, this e is so special that the function e to the power of x, if you take the first derivative of this function, it's again e to the power of x. It's so easy to take derivatives of this function. This is why we love it. And also, there is another special property of this function that we like. Unlike, when you deal with 1 plus r to the power of n, to find r, you have to be able to find the nth root of some number. And when you take the third root of some number, this equation has more than one solution. Quadratic equation has 2 solutions, and sometimes there are special cases when you actually don't know which solution is the correct one. Well, with the e, let me give you an example how you solve these equations. It's very easy. Imagine the case in which somebody tell you, okay, if you invest in this project $50 now, after 10 years, you will get $500. How much percent per year do you earn? How much do you earn in percents? Well, this is pretty easy equation to solve, basically, because you know that 50 times e to the power of 10r must be equal to 500. And it's very easy to find r from this equation. You don't have any square roots and stuff like that. You just divide everything by 50 and take the natural logarithm of this. And then if you take the natural logarithm of this, you get that 10r is equal to 2.3. Basically, r is equal to 23%. If you had the 10th root, this equation would have 10 solutions to this problem. Yeah, in this case, it would be easy to spot the right one. But there are cases when it's very difficult to choose the right solution of these power equations. So in the limit, as we compound more and more frequently, we obtain continuously compounded interest rate. 100 grows to 100 times e to the power of rt when invested at continuously compounded rate r for time t. Now, the last bullet on this slide you still cannot understand because it talks about basically discounting and present value. But when you discount in this world, you discount by the discount factor becomes e to the power of minus rt, which is basically the same as you divide with e to the rt. Now, some people claim that Albert Einstein once said the most powerful force in the universe is compound interest. You can find this even in some brochures of investment funds of Deutsche Bank. You can find this quote everywhere on the internet, but if you ask me, I really don't believe that Albert Einstein said this. But the point is that if you use simple interest and you start with $1, after 30-something years at 10% interest rate, you won't have that much. But with compounded interest rate, these things grow exponentially. Your investment grows exponentially. And after 30 years, you will have almost 20 times more than you had when you invested. But there is another argument why one shouldn't take this so much seriously. And it lies, if you see, this function is pretty flat at the beginning. And when I say at the beginning, I mean first 10 years. And it gets even flatter if the interest rate is small. I mean, this is 10% interest rate. But imagine if the interest rate is like in reality, if you go to a bank, they give you like 1.6% on your savings or something like that. Well, there is one comic that is kind of joking with this kind of Einstein quote, which I don't believe is Einstein's quote. So, sure, 2% may not seem like a lot, but it's compound. If you invest $1,000 now, in just 10 short years, you will have $1,219. Come on, in 10 years, you will have $200 more. Okay, so compound interest isn't some magical force. Yeah, I'm just going to try to make more money and not to save like this, in a sense. So, I mean, compound interest is powerful. I mean, it grows exponentially, but, you know, one should be aware of the limits of this exponential growth. If the rate is small, I mean, after 10 years, this is not after 1 year that you're gonna get rich. I mean, after 10 years, you will just have a slightly bit more than you had. Okay, now we move to probably the most important concept in finance, which is called the present value. And we have covered it in our introductory week, but we have to do it now again because it's super important. So let me ask you one thing. Do you prefer $100 now or $100 in a year from now? Everybody prefers $100 now. But if I ask you, do you prefer $100 now or $110 in a year from now? Now, one could think that this answer depends whether you are impatient or not. One could think that the answer to this question depends on a fact whether you really want to spend your money now or you don't care. You can spend it in a year from now. And in a year from now, you'll be able to spend more. Well, it turns out that this is not the correct answer. It turns out that this answer doesn't depend on the fact whether you are impatient or not. It depends on the fact whether you can actually invest and borrow money at some rate or not. Imagine that you are really, really impatient guy, that you want to spend all your money today. And if I tell you $100 today or $110 in a year from now, you say, I want it today. But imagine that you can borrow from a bank at the rate of 5%. You can go to a bank and borrow $100 at the rate of 5%. Well, then you prefer $110 in a year from now, because you can borrow $100 today. In a year from now, you will be asked to repay $105, and you will be still left with $5 more. Or you could have borrowed more than $100 today and repay the bank debt with $110 in a year from now. So basically, this is the basis for the concepts of the future and the present value. So if you have some $110 in a future, the present value of this $100 today is basically what makes you indifferent. If you can get money at some rate that will make these two numbers equal, that will make interest on this investment such that makes these numbers equal, this gives you the basis for the future value and the present value. So basically the future value is the amount to which an investment will grow after earning some interest. And the present value is value today of a future cash flow. And what does it mean, value today of a future cash flow? That means what amount of money do I have to have today, and if I invest it at a given rate, I will give the same amount of money that I'm looking in the future. So what's the present value of $110 in the today? So for example, $100 in a year from now, what's the present value of this? Well, this is the amount of money that, given the interest rate, let's say that the interest rate is 10%, then if you have $100 today, if you invest them at 10% rate, in a year from now you will have $110. In order to calculate present value, you need this discount rate. And we will see later that this discount rate depends on the risk. And using this discount rate, you can come up with something that is called discount factor. So how do we calculate future values? Well, if you do some discrete compounding in some discrete periods of times, for example, annual compounding, then you do it like this. In a year from now or in 3 years from now, you will have 100 times 1 plus r to the power of, let's say, 3 after 3 years. So the future value of $100 today is 100 times 1 plus r to the power of 3. Now, what is the present value? But it's simple. You just have to divide this thing by 1 plus r to the power of t. So if you at the end have, for example, after 1 year, you have $110 and your interest rate is 10%, that means that the future value of $100 is $110. How do you calculate the present value? You just divide 110, the present value of $110 is 110 divided by 1 plus R. This is simple. Or in continuous compounding, future value is calculated by multiplying by e to the power of RT. So let's do the example. What is the future value of 100 if interest rate is compounded annually at the rate of 6% for 5 years? How much do you get after 5 years, basically? This is what the future value is. Future value is how much do you get at this rate after 5 years. So the future value is 100 times 1 plus 0.06 to the power of 5, which is 133.82. Or in the continuous compounding, you would get 134.98. How do we get to this number? Well, we multiply 100 by e to the power of r times t, where t is in years and r is a decimal number interest rate. So how do we calculate present value? Well, present value is equal to the cash flow, and I put here index 1. You see this C1. Because currently we are thinking only about a single cash flow in the future and how to calculate the present value of the single cash flow in the future. In the next class we will have multiple cash flows. We will have cash flows that go even to infinity. So we have to multiply it by the corresponding discount factor. And what's the corresponding discount factor? Well, for a discrete world, it will be 1 over 1 plus r to the power of t. So if you are receiving a cash flow in 3 years from now, that means basically that to calculate the present value of this cash flow, you have to divide it by 1 plus r to the power of 3 if it's in 3 years from now. If you want to discount it in continuous time, you have to multiply it by e to the power of minus rt. I guess you all understand that e to the power of minus rt is the same thing as if you divide it by e to the power of rt. That's the same thing. It's just a different notation. So let's do one example again. Imagine that your boss wants to decide whether to build a building, whether to invest into building of a building. And in order to construct this building, he needs to pay today to a construction company $370,000. And after 1 year, he will be able to sell this building for $420,000. Now the question is, your boss asks you, okay, should I do this or not? Now, somebody naive who doesn't understand the concept of present value would say, well, if you invest $370,000 and you are able to sell this for $420,000, that means that you are good $50,000. Of course you should do it, but this answer is wrong. Why is this answer wrong? Because this answer tells you, yeah, you will earn $50,000 over 1 year. But imagine that alternatively, you do not keep this $370,000 in your pocket. Your bank had a good day and said, let's give a really good interest rate to our customers. Let's give them 20%. Let's be generous. Let's give them 100% on their investment. So alternatively, your boss could have invested into this bank and instead of earning this $50,000, he could have earned $370,000 more. Because this bank had a good day and wanted to give 100% interest rates. So basically, whether he should do that or not depends what are his alternatives. Alternative is not to keep your money in a pocket and then say, yeah, I'm 50,000 good. Alternative is to invest this into something. And basically, what you want to do is to compare this project with something else that is similarly risky. And let's say that similarly risky thing would earn you 5% per year. Let's say that constructing a building is not that risky, and let's say that This is like 5% per year. Well, how do you do it? Well, then you can calculate the present value of this future cash flow. You will be able to sell it for $420,000 in a year from now. How much is that worth today? Well, this is worth 420 divided by 1.05. This is 400,000. Or in continuous compounded, if the rates are continuously compounded, you multiply it by e to the power of minus 0.05. So, the idea of net present value, it tells you, well, you should do the project if the net present value of the project is positive. And the net present value is basically cash flow, net present value of the cash flow that you get minus the investment that you do. So this project would be good $30,000 in today's money. Not some imaginary difference of 420 minus 370. This is in today's money, you know. Now this 400,000, this is what you would, this is basically what this 420 is worth today. If you invest 400 today at the rate of 5%, you would get 420. So basically, net present value is the present value of the cash flow that you get minus the required investment. Or if you look at the bottom equation, I introduce a bit different notation here. I call investment C0, and you know C0 is negative in this equation. C0 is a negative number, while the required investment on top is positive because it has a minus sign in front. So keep note of that. And the idea is basically that higher risk projects require higher rate of return. What is the rationale behind this? If I ask you, I can offer you to invest in super safe bank at the rate of 10%. And the alternatively, you can invest in Greek bonds at the rate of 10%. What do you choose? You choose, of course, to invest in a bank at the rate of 10% because it's safer. But, I mean, you know, there are still people that invest in Greek bonds. You know, Deutsche Bank will offer you rate on your investment of, I don't know, if you put your money on your account, you will get, I don't know, some peanuts, like 1% or something like that. But if you buy Greek bonds today, you will get like 25% return. But this is because they are riskier. Riskier things require higher rates because nobody will buy them for low rates. In order to incentivize people to buy them, you must increase rates. But what happens with the net present value if you increase the rates? Now, let's imagine that actually this is a risky building construction and that something equivalently risky offers you 12%. What happens with the present value? Well, present value goes down from 400 to 375,000. So basically then the net present value of this project becomes smaller. It becomes 5,000. And actually you can push this to the limit in a sense. You can push this, let's say that this is a very risky thing, that this is as risky as Greek bonds, which offer 20% return. Well, then the net present value of this project becomes negative. And you don't want to do it because this is equivalent of losing $20,000 today. This is what net present value means. This is equivalent of losing $20,000 today. So basically net present value rule tells you I invest if the net present value of the project is positive. This is a good investment. Good investments can have positive net present value. There is an alternative way, which is kind of, I think, even more intuitive that you can look on these things, which is called rate of return rule. So what is rate of return? Imagine that you have this building construction project. And how much percent do you earn if you invest in this project? So you basically invest 370 and your profit is basically in a sense 50. So over a period of 1 year, you are earning 13.5%. So you invest 370, you earn 13.5%, you end up with 420. Now, the question is, should you do this project or not? The answer is, by the rate of return rule, you should do it if the rate of return that this project is offering you is higher than the alternatively risky investment, similarly risky investment. Imagine that something of similar risk is offering you a return of 12%. Should you do this or not? Of course, because if you do this, you will get 13.5%. If you do something which is similarly risky, you will get 12%. But imagine the previous case. What if something alternative is offering you 20%? Of course you won't do it. You will invest in a project that will give you 20%. You won't do this project that offers you 13.5%. So this rate of the return rule for determining whether to invest or not is very simple and intuitive. But it has its issues. When you have cash flows over multiple periods of times, and real investments usually do have that, you have problem. You don't know how to calculate proper rate of return. And we will see much, much more about that in some future classes. Okay, now we are ready actually to answer the question. What should managers of corporations do? What should be the goal of every manager of every corporation? So, as we said, ownership and management in corporations is usually separate. And you have different shareholders in corporations. Let me give you an example of my neighbor. She is like 75 years old lady who is spending all her money on some wild vacations. I mean, she goes to Brazil like every 3 months or something like that. I mean, she's all the time vacationing in these distant, remote, nice places. And this is a rational thing to do in her case. I mean, should she save money when she becomes 90 or what? I mean, she will probably die next 10 years. I mean, and on the other hand, you have some young family who just got a kid. And they are aware that their kid is going to start to go to university in 20 years from now. They have to save money to pay for his tuitions. So, imagine that this neighbor of mine owns 50% of the company and this young family owns another 50% of a company. What should manager do? This old lady tells him, okay, I want money. I want money now. I will be dead in 10 years from now. I want money now. And this guy's tell the manager, no. I need money in 20 years. Please invest, and make as much money as you can, and give me this money in 20 years. So what should manager do in this kind of situation? It turns out that this story with the net present value gives a very, very easy answer. That the goal of a manager should be to increase the net present value of a company. And we will now see why. What's the rationale behind this? Let's try to understand this. Let's try to understand first this chart, what our axis is on this chart. So, x-axis is income in period 0. Y-axis is income in period 1. So, dot B, this point B on this chart, this is a person who wants to consume more money in period 0 and less money in period 1. While the person A wants to consume less money today and more money tomorrow. So basically, person B is this neighbor of mine who wants to spend as much as she can today and less in the future. And in the book, they will not give you this story about the old lady that wants to have wild vacations before she dies. They will give you a story about grasshopper and the ant. This is the famous, fairy tale where this ant is playing violin and having fun, like my landlord, not landlord, my neighbor. And, this is a grasshopper, and the ant is the one that works all winter hard, saves money for the college of his kids, whatever. And now imagine that the company, and they are jointly owners of this company, manager has an opportunity to invest 185,000, actually double that amount, wants to invest into some project. And you know, both of these guys have invested $185,000 into this company. So what happens? If the manager decides to do nothing, then landlord can spend $185,000 today. She can go to a really wild vacation. Well, you know, these parents, after a year, when their kid starts going to college, will accumulate some interest. They will invest this 185 at the interest of 5%, and they will end up with $194. But alternatively, you know, manager of a company says, you know, I have a project. If I invest into this project, in a year from now, you will actually have $210. And this is a project that increases your net present value. It earns you more than otherwise you could on something similarly risky. So, you know, the answer for the guys that are saving for the college of their kid next year, it's an easy answer for them. So in a year from now, I will have 210. That's great. He will be able to go to a better school. But ladies say, wait. In 1 year from now, I'm dead. I want to spend my money now. And you know, they own half of the company. So manager is like, okay, what should I do? But the lady should understand the following. If she is able to receive 210 in a year from now, that means that she can go to a bank today and ask him, okay, I'm getting for sure 210,000. My manager told me that for sure he has a project that is totally riskless that will give me $210 in a year from now. Can you borrow me some money? They say, yeah, sure, no problem. Interest rate is 5%. She says, okay, give me $200 because in a year from now I will have $210 and I will be able to repay your debt. I will be dead, but you know, money will be there. Corporations does not disappear when I die. So she borrows $200 today, she goes to a really wild vacation, dies of a heart attack, and then in a year from now, you know, company gives back these $210 to the bank because she borrowed $200 at the rate of 5% and repaid $210. So everybody is better off with the projects that increase net present value. Even those that are impatient or those that are not that are patient, that want money later, no matter when you want money, it's better for you if the net present value is increased. So actually the manager, it's an easy task to identify ideal manager. Ideal manager is the one that wants to increase the shareholders' value. Now the problem is that in reality, any manager wants to increase the amount of money in his own wallet, in his own bank account. And now corporations have to find optimal mechanisms how to motivate managers actually to increase shareholders' value. And there are a couple of mechanisms to deal with this problem. We will talk more about them later, but you know, usually you have a board of directors above the CEO, above the manager of a company. And usually major shareholders sit on this board. And if manager is not working good, they just fire him and take somebody that is not striker, that is not lazy, and put somebody that is actually maximizing their shareholders' value. They can also give some financial incentives to this manager. They can tell him, okay, your salary will depend on the performance of the company. I want you to increase my shareholders' value, so you do not get fixed salary. Your salary depends on the performance of the company. And, you know, but I tell you this story that you should increase shareholders' value, but not all managers actually think that. If you ask managers in different countries, first, who is the owner of the company? Even though legally shareholders are the owner, in Japan, managers believe that also people employed in the company own the company in some sense. Even though on paper they are not the owners. They are stakeholders in a sense. This is what stakeholders are: all interested parties, shareholders, employees, whoever has some interest in this company is a stakeholder. And in Japan, most managers believe that also employees should have some rights. Germany is also pretty socialistic in that respect. In the US, it's clear cut. It's very clear cut. Shareholders are the owners of the company. And actually, when you ask these same managers, should we pay out dividends or should we, invest in job security? There is some, we don't have really cash. Should we fire some people or pay out dividends? In the US, people will say, dividends, this is my company. Well, in Germany and Japan, it's not so clear-cut answer. It's actually vice versa. Unions in Germany have huge rights. They decide on many, many things. And the point is, in the US, this is very, very clearly defined by law. You don't have freedom to interpret. In the US, it's a law that if CEO is not maximizing shareholders' value, he's criminally liable. It's a criminal offense not to increase shareholders' value. In Germany, this is not like that. So this is a law. This is not freedom of interpretation. Should I increase shareholders' value or should I think about job security? Shareholders' value is the first top priority of a corporation in the US. It's a criminal offense not to do it. And I don't know whether I have convinced you that this is actually the best thing to do, but the point is that corporations should increase shareholders' value. Now the problem is, how do you incentivize these managers, employees? How do you manage to incentivize all these people actually to work on this? Because employees that are afraid for their job, they might not have the same incentives to work really well as the employees that have very safe jobs. It's a different problem. And as I told you, you will basically learn much about it in your economics class. And this is a very important problem. Why? Because corporation has solved one important issue. It has solved this unlimited liability, and it has led to tremendous economic growth, but on the other hand, it has created another problem, this so-called agency problem, conflict of interest between managers and shareholders. I end my class here. Any questions, comments, short speeches?